Hi everyone, Nick here, welcome back. When I started investing, I followed some of the standard fund placement advice that often recommends putting ex-US or international funds in a taxable account. Now, fund placement is about taking your different types of investments, the US fund, the ex-US fund, or a bond fund, and placing them into different accounts, like your 401k, IRA, or taxable accounts, based on the tax treatment of those types of investments. And for ex-US or international stocks, if you place them in the tax-advantaged account, it's possible you'll be able to leverage the foreign tax credit. However, I've since stopped doing this, and I've even moved my ex-US allocation almost entirely into my tax-advantaged accounts. There are some scenarios where placing international and taxable could save you money, or it could even cost you money in other ways that can offset the tax credit. It's a bit complex, but I'm going to break down what I've learned in this video. We'll start with an overview of the tax credit, then I'll share a mistake that I made that could have ended up costing me a lot of money. If you invest in international stocks, it's a good idea to educate yourself on the foreign tax credit. First, the foreign tax credit is for US taxpayers. It's intended to prevent double taxation on income you earn from your international investments. This is because your fund is paying taxes to foreign governments when it receives earnings from the stocks it holds, and then the US government allows you to deduct those taxes already paid to foreign governments in some cases against your US tax bill. So let's take a quick look at an example. Let's say you've built a $100,000 taxable portfolio right here, and it's in VTIAX or VXUS. And your joint annual income is $100,000, which puts you in these tax brackets for the qualified dividend tax rate and the non-qualified dividend tax rate, which is taxed like ordinary income. Now, last year, VTIAX yielded approximately 3%, so we'll use some round numbers. So let's say that's $3,000 in dividends. When I looked into it, the approximate ratio that the fund paid in taxes of foreign governments that could have potentially been claimed as the foreign tax credit was about 6.8%, or in this case, just a little over $200. Then also the ratio for qualified dividends was 59% of the dividends were qualified, which you get taxed at the lower tax rate. And then 41% at the non-qualified rate, which at this income level would be 24%. So this would bring your total tax obligation to $356.70 approximately. Note there are requirements to qualify for this foreign tax credit. For example, your fund must hold more than 50% of its assets in international stocks to qualify for the credit. So currently, funds like VT do not qualify for this credit. You also have the option to take an itemized deduction instead of a tax credit. There are also formulas on Form 1116 that could reduce the amount of the credit you qualify for. Taxes can be complicated, and the foreign tax credit is complicated. I'll put a link to the IRS page on this tax credit below so you can investigate further or discuss with your CPA. Do not construe this video as financial or tax advice. It's possible I made some mistakes, my calculations, or my research, so it's important that you do your own research. If you hold your ex-US or international in a tax advantage account, like a 401k or IRA, you do not get to use this credit. Your fund is still paying taxes to foreign governments, but you lose the chance to deduct it against your US taxes. For this reason, it's often recommended to try to place international into a taxable account if your asset allocation and account balances allow for it. At one point, my taxable account was almost 100% international stocks as I built my portfolio. However, I learned more and I realized this is probably a mistake for me. If you're new to my channel, welcome. While many videos might end with this amount of detail, we often go deeper into subjects on my channel. I do my best to find the most relevant details and summarize them as simply and quickly as possible to deliver you the most value. If you want to support my channel, hit the like button and share my video with your friends. For a long time, I thought that I might as well try to hold my international stocks in a taxable account so I could claim the credit. I thought if I'm paying taxes to foreign governments, I might as well get the tax credit for it. I talked about this in my video on tax-efficient asset allocation, which I'll link above and below. But after a while, most of my international stocks were in my taxable account. And I think it made sense early in my investing journey, but I don't think it makes sense for me now or long term. And this is because of three things. First, my wife and I substantially increased our income, which changes the equation quite a bit. Second, I started analyzing how our taxes might look in retirement, and I learned additional quirks of the foreign tax credit. And third, there are some interesting tax planning opportunities I learned about, especially for retirement. Now we're going to discuss all of these in more detail. First, let's look at how a higher income changes the equation. For demonstrative purposes, let's say we earn $500,000 in a taxable account. That would make our ordinary income tax rate 35%. However, then, since our taxable income is over $250,000, which is not indexed for inflation, so it could apply to you sooner than you may think, you have to pay a net investment income tax of 3.8% on investment income. So that brings the tax rate up to 38.8%. And then the dividend tax rate for qualified dividends is 20% plus the 3.8% for investment income. So now if you take the same example we had before with the $100,000 portfolio, the tax rate is substantially higher. So you're looking at going from $356.70 in taxes on your annual VTIAX dividends, almost double, to $694.50. It's 94.7% higher. And at this point, you may start to question if it makes sense to hold international shares in your taxable account. This is one of the first things that got me starting to think about it. Now, you may think it's unlikely that this situation applies to you. I actually thought this when I started investing. I had no idea I'd be able to increase my income as much as I was able to. So I would caution to not discount the chance of earning more money and being in a higher tax bracket, especially if you follow tips I discuss on how to increase your income and focus on growing your career instead of trying to time the market. Now, last year, the International Stock Index paid a little over 3% in dividends, while the US Stock Index only paid about 1.25% in dividends. And this is just the difference in how US and international companies are distributing profits. US companies are doing more things like reinvesting profits or using it for share buybacks instead of paying dividends. Additionally, US dividends are more tax efficient. As we saw, the international fund only had about 59% qualified dividends, qualifying for that lower tax rate, while the US fund was 95% qualified. Not only that, the remaining 5% of non-qualified dividends for a fund like VTSAX were 199A dividends, which currently get special tax treatment with a 20% deduction. In this sheet, I've added VTSAX or VTI for comparisons. We could look at what the tax treatment would be like for the $100,000 joint annual income. So we've adjusted it for the dividends, the qualified versus non-qualified ratio, and then for the 199A dividends, we multiplied it by 0.8% to reflect that 20% deduction. So this is just an estimate, but should be pretty close. But we can see that that would lower our annual tax liability on that $100,000 down to $190. Yeah, we would be foregoing this tax credit. And a major trade-off here is that the US share prices will be a bit higher when we go to sell, which may result in more capital gains in the future. But that depends on what your income is in the future. A lot of people, especially people in retirement, will have lower incomes in retirement and thus be in lower tax brackets than they are now. So it allows you to defer your taxes kind of like a traditional 401k, since you're accumulating more capital gains than realizing distributions every year with a higher income. And in the extreme end, under the current tax code, in 2025 tax brackets, it's possible for a couple to earn about $126,700 from investments and pay less than $500 in federal income tax. Yes, that is correct. For a married couple filing jointly, if your taxable income is under $96,700, you would be in the 0% dividend and long-term capital gains tax bracket. You would also get a $30,000 standard deduction, which you could use to offset ordinary income or possibly Roth rollovers. And that totals $126,700 of income that could be tax-free. I made a video about this with a lot more details where I walk through the tax calculations and so forth. I'll link it above and below. But the same concept applies here. Now that video is a couple years old, so the tax brackets and deductions were a bit lower, but it's basically the same concept with higher limits. We are talking about tax laws, which will certainly change, but I think it's reasonably likely that my wife and I will have lower tax rates on dividends and capital gains in retirement than now. And I think we will pay less in overall taxes with the US in our taxable account instead of in international. When we were in a lower tax bracket, I was comfortable getting more dividends now and thought it could be better to be able to take advantage of this tax credit. However, as my income grew, the math changed and it looked a bit more like this, where the amount of tax liability I had every year on my VTIAX dividends was very high. And then by switching it over to VTSAX, I was able to drastically lower that. So this is one of the first reasons why I decided to move my international allocation into tax-advantaged accounts. This brings us to the second thing I learned, which are quirks of the foreign tax credit and how Form 1116 affects your eligibility for the tax credit. First, the foreign tax credit cannot exceed your average tax rate. In the example I just shared of a couple earning up to almost $127,000 of income and paying almost no federal income tax, that tax rate is far below the tax rate that VTIAX is paying to foreign governments. So you wouldn't be able to qualify, or I wouldn't be able to qualify to claim possibly over 85% of that credit. So then having it taxable wouldn't actually help. Additionally, if you exceed $20,000 in foreign qualified dividends, the amount of the foreign tax credit you're allowed to take is reduced based on your income. Now, Form 1116 is the form that you would use to determine this, and it has many calculations you can use to estimate hypothetical scenarios. I use tax software for this, and instead of manually using the form, to get rough estimates of how the foreign tax credit would affect different hypothetical incomes in retirement. The estimate was that I would only be able to qualify for about 15 to 65% of the foreign tax credit in retirement, depending on my withdrawal strategy and so forth. However, it would be quite common for someone living on investment income to have significantly reduced foreign tax credit due to the calculations on Form 1116. Now you can go and look at this for your specific situation and try to make some different estimates. So this brings us to the third point, which is a tax planning opportunity. Now, if US stocks stay more efficient, where they are 95% or more qualified dividends, and they overall pay less in dividends than international, this gives us much more control over our taxes in retirement. Now, in this example, let's say our taxable position is $1 million, and that's in VTIAX. That would result in annual dividends of around $30,000, which would be awesome. However, if it were in the US stock index, it would only be $12,500, since more of the profits from the companies would be going towards growth in the share price and thus long-term capital gains if you're holding it for over a year. And if you keep the joint annual income at that level I was talking about, let's just say $125,000 to make it easy, you could end up in the qualified tax rate of 0% for qualified dividends and long-term capital gains. And then your non-qualified rate would be about 22%. But you'd actually have to do the math, because it could be lower due to the deduction and the progressivity of the tax bracket on non-qualified income. But just to make it very simple, I'm just going to use 20% since it doesn't affect these calculations very drastically. So let's say in VTIAX, you might end up being able to take a $2,000 tax credit, except Form 1116 calculations would reduce that significantly. And in my estimates, I would only be able to take maybe 15 possibly 65% of that depending on my income. And taking a forced distribution of $12,000 or more in non-qualified dividends hurts quite a bit compared to a fund like VT, where it's only $625 of dividend income that would be taxed at the ordinary income tax rates, whereas the rest would be taxed potentially at the 0% rate. So this is really the major difference, is you get to control when you take the distributions a bit more using a fund like VT and taxable. Whereas in this one, this non-qualified dividend of $12,300, you have no control over that. You can't determine when you're going to take it. And now I would rather be using that to do Roth conversions in early retirement than being forced to pay taxes on these non-qualified dividends, which I may not actually even need depending on the situation. So in aggregate, I think I would just rather have more control for these types of tax planning opportunities, to control where I'm taking different types of income and the associated taxes. I think it will help me lower my overall tax rate. A lot of my viewers like to invest in VT for the simplicity. There's nothing wrong with that. So I just thought I'd briefly talk about it and show it in these calculations. It has slightly higher dividends, around 1.85% for the last year. And I actually forgot to update this to non-qualified dividends. Some of those might be 199A dividends. I didn't double check. I just assumed maybe a 5% deduction on that amount. So you can actually do that estimation better yourself. This is just a rough approximation. So your total tax liability might be around $310. Then for the higher income tax rates at the $500,000 hypothetical income, it would be almost $500 in the annual tax liability on that every $100,000 invested, compared to around $700 for just using VXUS or $300 for VTI. These are just approximations. And then when we look at the $1 million in retirement, VT would have a similar concern, not quite as bad as VTIX, where it's kicking off around $4,000 in these non-qualified dividends. Again, the same mistake here, I should have made that non-qualified. But the point stands, is that this is also a consideration for VT. So to repeat, these are the three reasons why I decided to move most of my international allocation to tax advantage accounts. First, substantial increase in my wife and my income. Second, estimates of taxes in retirement and quirks of the foreign tax credit. And third, different tax planning opportunities in retirement. I took advantage of the opportunity to tax loss harvest most of my international and my taxable account, and I converted it to US stocks during the 2022 downturn. I compensated for this in my tax advantage accounts to keep my overall allocation the same. The foreign tax credit is a very complex thing when you consider how it will change your income in retirement and so on. You should certainly consult a CPA or learn the various details yourself. Now, I wouldn't blame you if you just said, screw it, I'm just gonna buy VT and be done with it, even if it means I might pay a little more in taxes. This stuff can get complicated, especially if you wanna optimize it. In my opinion, having a solid asset allocation and sticking to it gets you over 95% of the way there. And little nuances like this aren't worth it for everyone. It does take time to dig in, learn the details. There's complexity, might make some mistakes. There's a lot of hypotheticals and forecasting, which may not always go to plan. So I could see just saying, screw it, I'm just gonna go with the very simple path. It does make a lot of sense, but I'm an engineer and I tend to like to optimize things. And now I do think the foreign tax credit probably makes more sense when in lower income brackets during earning years, similar to the Roth versus traditional trade-off. I think it was probably good for me when I started my portfolio, but not as life changed. And a lot of this is unpredictable since life and tax codes can change over time. But it's good to think about the trade-offs in your retirement withdrawal strategy when you design your asset allocation. So what do you think? What's your strategy for international fund tax placement in your accounts? I'm interested to hear how you're approaching this decision for asset allocation with US and international in the comments below. If you enjoy content like this, make sure to hit the like button and share my channel with your friends. Thanks for watching, everyone. Later.